Good morning. I'm Allie Canal in for Brian Sazi, and you're taking a live look at the opening bells on Wall Street this Friday morning. This as markets are set to end the week in the red. Crypto is selling off, and the U.S. government remains closed on what should have been the date of the October jobs report. Now, Opening Bid is all about serving up the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make the best decisions with your money. But first, let's get a quick check on the major averages as we kick off trading and send it down to our own Brooke DePalma, live from the NASDAQ in Times Square. And Brooke, it's been quite the week. How are we doing to open up things on Friday?
Allie, we're shaping up to not have that great of a start here on Friday's trading session. What we see at the NASDAQ down about 0.7%, the S&P 500 down about 0.5%, and the Dow down about 0.4% at the open here. And some key trending tickers that we're also taking a look at the open include some like Bitcoin, which I know we'll get to in the show. That now hovering around 100,000, down this morning nearly 2.5%. Also, Open Door after its earnings report tumbling at the open, down more than 18%. We also have Ethereum, another cryptocurrency, also seeing a bit of downward momentum, down 3.8% this morning, and Constellation Brands also down. And so what we're really seeing at the open across the NASDAQ is this downward momentum led lower by Nvidia and Tesla, some of the key players I know we'll get to in the show, Allie.
All right, Brooke, thanks so much. A lot of good teases there. And we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what we're watching. First up, the tech sell-off continues with AI stocks falling from recent highs. Crypto in particular erasing the majority of year-to-date gains. Plus, what's next for Tesla after shareholders approve CEO Elon Musk's hefty $1 trillion pay package, and the government shutdown continues, flights now being canceled as the costs continue to pile up. Here to break it all down, our panel this morning, Young-Yu Ma, PNC Asset Management Group Chief Investment Strategist, alongside Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. And Young-Yu, I want to start with you here because this week in tech has been pretty brutal. What do you make of the latest sell-off? Is this a healthy correction or maybe a sign of something a little bit more sinister?
Thanks. It's great to be here. We do see this primarily as a healthy correction. There certainly have been some areas of the market that have gotten extended, perhaps some valuations being more than could be supported by current growth estimates. So we see this as a healthy correction. We do think the market will find a bottom without spiraling downward here. But right now the market is under some pressure, and this will probably continue in the short term. Are you encouraging clients to buy the dips at this point? Well, I think it pays to be patient. It depends how exposed clients are. We do think clients should be exposed and have a healthy exposure to the AI themes, the technology that is going to be the growth driver of the future. We don't think that trend is going away. We still think it's in the early innings and there's a lot more to go. But that said, over the course of days or weeks, you can get a lot of back and forth in the market. So I think it pays to be patient here, but also to look for opportunities. So how do you play that then? If CapEx generation and really the returns and the ROI that we're going to see from AI is still years away, how do you stay invested in this space while not falling behind in other areas or pockets of the market that maybe are undervalued? Yeah, well, one, we don't think it's years away. We think some areas are seeing earlier gains and some areas are probably going to take a bit longer. But we do think that those benefits, the productivity is going to be real. It's going to benefit the economy, going to benefit companies, and going to benefit consumers and individuals as well. So I think as a starting point, it's important to look at which companies are actually starting to see the earlier gains, where are margins expanding. Nothing in the market is really cheap now. I think that's the challenge that we have. It's hard to point to a sector or an area and say this is a safe haven because there's so much disruption in the economy, so many shifts going on, changes happening very fast. And when you have a highly valued market and you have those changes taking place, there aren't necessarily areas to hide out. I think the reality is you still want to lean into the primary growth trends, and that is AI and technology. And another theme this week that emerged is crypto. Bitcoin heading for a decline of 9% this week, its worst week since March. And Inez, you've been following the crypto space very closely here. What's behind this drop and what are strategists saying could come ahead?
Yeah, Allie, I just got off the phone with the head of 10X Research. This is a research firm that's based out in Singapore, and they've made some pretty accurate calls over the last month, starting in the summertime, really. But basically, look, you've had these OGs, these long-term holders of Bitcoin that have been selling since the summertime, really, and you've seen sort of an acceleration of that selling over the last month or so. So that has weighed on the markets. You had the October 10th liquidation, which took out some very important technical levels. Some smaller investors were also liquidated there. And so what this firm is saying is that their base case is that the Bitcoin industry is now in a bear market, but they do not see this bear market lasting like in the one in 21. I mean, technically, it isn't a bear market because it's off 20% off its all-time high, which was reached about a month ago. But what they're saying is that if you break the 93,000 level, then you could see an air pocket and you could go further down. They're predicting perhaps into the 70s. You know, at that point also keep in mind that fund managers that have been buying ETFs, and they may also be forced to sell as well, because why would you hold a long position or a substantial position in these Bitcoin ETFs if it's falling? So there are some risks in the near term. What could turn things around? I mean, there are catalysts that could turn things around. The Fed could decide to cut in December. You could have more of a regime change at the Fed going into next year. You could see the government reopen. So there are catalysts that could turn things around. But right now, we are seeing quite a bit of pressure in the crypto market in general.
Yeah, interesting. Perhaps the start of another crypto winter. And beyond the tech space, one name in particular that's still holding on to gains this week is Tesla. Shareholders just approving that nearly $1 trillion pay package for CEO Elon Musk. Brooke, you've been reading a lot of this Wall Street commentary. What's been the reaction on not just the vote, but really the overall meeting?
Allie, what we're seeing this morning is Tesla down nearly 4.5%, almost near 5%. Taking a look at the YF Interactive, I'm taking a look at this chart over the last 2 months. It's had such momentum leading up to the shareholder meeting, up nearly 21%. And over the past 10 days, it's been modest, about down 2%, considering the decline that we're seeing this morning really take hold. But we're hearing some rhetoric across the street, particularly from CFR analyst Garrett Nelson, who doesn't necessarily see this, as all that positive. He does still have a sell on the street. He said that they continue to view Tesla as susceptible to multiple contraction and expect a drop in vehicle sales starting in Q4. So despite all this optimism, especially going into this shareholder meeting where it was largely expected that Elon Musk would get this pay package approved, keep in mind there are multiple different factors that have to go into this to see that return on that $1 trillion pay package. It doesn't look like exactly is holding up. It's not necessarily going to lead to that $1 trillion payout right away. And investors and analysts sort of a bit skeptical here and there on where exactly this could go from here.
Yeah, in a lot of ways, Tesla being rewarded for something that hasn't quite happened yet, which is the robo-taxi rollout. But I also want to switch gears and talk a little government shutdown, because that just continues to drag on. We now have the FAA slashing flights, that delay in economic data, Fed officials essentially flying blind at this point. Young-Yu, we've been hearing more commentary around the potential impact on GDP. How do you look at that impact and maybe the confidence that businesses could be feeling at this point, or the lack thereof?
Yeah, I think this is a tricky one because the markets and perhaps the government officials were lulled into a sense of complacency because in the early days of the shutdown, you really don't have many immediate effects. The impacts are quite modest, but as you go along, the effects actually start to pile up, both on consumer confidence, economic disruptions, business uncertainty. Businesses are already in a state of high uncertainty from the tariffs, and they're already kind of dizzy from the tariffs and not knowing what to do. And a lot of businesses are responding to that by not hiring. And I think you just have this compounded on top of it. And so as this goes on, you actually can get some increasing economic disruptions, hits to confidence that do have real economic and market impacts, because I think the sentiment now is really starting to creep into the markets that this is a difficult and increasingly harmful environment with the government shut down this long.
Do you think markets are underpricing some of that risk right now, or are you starting to see signs that, like you said, they're realizing, okay, investors are realizing that this maybe is something that could continue well into the holidays?
Well, I think it's part of the softness that we're seeing in the markets. I think this adds to some of the challenges, the headwinds, and it's not this sort of straight line process. Once you get a number of uncertainties that start to pile up, all of a sudden you start to see heavier weight on the market and some downturns or pullbacks. And so I think that's part of the mix of what we're seeing, along with some areas where valuations might have been stretched. It's just wondering, given the state of affairs, are these companies worth this much in terms of paying for this growth? And if you're not confident about the future and the direction, it's hard to be confident about really paying premium multiples here. So it all comes together, but I do think that we're probably within, say, 10 days likely to see a resolution, but it has to happen rather than just speculation.
And Brooke, retailers are already flagging weaker consumer demand heading into the holidays. How much of this is shutdown related versus tariffs versus still sticky prices on the inflation front?
Allie, I think it's a combination of all these economic factors that are certainly making consumers a lot more picky. I spoke to one of my sources at PwC earlier this week, and she was telling me that this low-income consumer continues to remain under pressure. The high-income consumer needs the stock market to do well. And on top of that, too, you have rising costs, you have the government shutdown, and you have the fear that tariffs are going to increase prices. What I'm hearing, though, is that tariffs will increase prices more so in the first half of next year as opposed to ahead of these holidays. Retailers really need to do well this holiday season. They need to keep prices pretty modest for consumers to go in, but we are still expected to see a modest single-digit increase year over year this holiday season when it comes to sales. But NRF sort of warning here, saying that a notable headwind this year is that federal government shutdown, the timing of which is particularly challenging during this holiday season.
Yeah, certainly a lot going on within the stock market as well as the overall economy, but stick with me, Young Yuma, Brooke, and Inez. But first, we're nearing a big day here at Yahoo Finance, our annual Invest Conference on November 13th, starting at 8 a.m. Eastern. We've got a special full day of live global coverage of the key themes driving the market. Yes, that means AI, crypto, and so much more. We'll be talking about the future of pharma with the CEO of Pfizer. Plus, Eric Trump will be stopping by to explain his all-in stance on crypto. And former Fed official Lael Brainerd will share her latest thinking on the outlook for interest rates. Don't miss Yahoo Finance Invest live all day on November 13th. Time now for our stock of the day. Take-Two Interactive, the maker of popular video game series Grand Theft Auto, announced yet another delay for GTA 6, pushing it to November of 2026. So with me on the opening bid roundtable, Young Yu Ma, Brooke DePalma, and Inez Ferre. Young Yu, I'm not sure if you're a gamer here, but the people, they're upset. Investors are upset too. We're seeing the stock down around 6%. When you look at companies like Take-Two Interactive, high beta, content-driven, long runway, what are your thoughts on investor positioning right now amid this environment?
Yeah, it's been a long time since I was a gamer, but I will say that 7% is a real decline, but it's also a big push out all the way until late next year. I think if it were a modest push out, the market would probably take it a little bit easier and be more forgiving. But the reality is that's the kind of market we're in here. When we see disappointments, those tend to get punished pretty heavily by the market. We saw that in earnings season as well, when companies that missed their earnings had a stronger than average negative reaction to the stock price. So the market is not very forgiving here, and you do need to see those growth estimates met and probably exceeded by a substantial amount for the market to be convinced that you're on the right trajectory and be able to meet these growth estimates and valuation levels that are at the companies are at right now. So I think that this action in Take-Two is indicative of that. It's a market that really is priced for high expectations and really wanting those to be met.
And it's funny because I think about this stock and then I think about the overall market, right? And overall market very concentrated in tech. And then it feels like, at least in the trading right now, very concentrated in the release of this game. Does this mean that Take-Two Interactive, it maybe needs some other growth levers to pull?
Well, it's important, I think, for any company to have a diversified set of customers, and in this case, the customers may be diverse, but the concentration in the product isn't as diverse. So that's certainly helpful for a company. It does add risk anytime there's a company that you have concentration in product. If that product rollout isn't as strong as hoped for or anticipated, you'll see a greater reaction or more concern about the direction of the company. So I think this does play into it, whether or not there are other areas of greater diversification that Take-Two and other companies like Take-Two can think about. I think that's an important consideration for all companies in terms of having a stable revenue base.
And as despite these losses escalating, we're now down over 8%. JP Morgan out with a note calling this a buy the dip opportunity, a $275 price target. What's really giving Wall Street this long-term confidence in this story? And if you take a look at year-to-date gains, we're still up around 35%.
Yeah, exactly. The stock has had a good run this year, and it hit all-time highs in October. And JP Morgan basically saying that the delay is overshadowing a strong quarter, and that's why they're saying buy the dip. Also, the reason for the delay is because of quality. It's not because necessarily of any other bigger problem. So Wall Street is comfortable. It comes at an inconvenient time because of the holidays, but nonetheless, Wall Street is comfortable with saying buy the dip. I mean, if you take a look at the ratings for this stock, you have 31 buy, 2 hold, and 1 sell, and the average price target for the stock is $274. So that implies an 18% upside from today's levels.
Well, hopefully for our gamers and our friends, including our tech editor, Dan Howley, our producer, Dan Nelson, hopefully they get that game in November 2026. But let's turn now to our question of the day, because today was expected to be the date of the U.S. jobs report, but due to the government shutdown, we didn't get that data. Now, with the absence of the full government report from the Bureau of Labor Statistics, private sector data stepped in. So what is the state of the labor market based on that information? And Young Yu, I'm going to pose this question to you. What did we learn about the jobs market with just that private market data?
Well, the private market data gives some important information. I think the Fed has always relied to a degree on the private data, but much more relied on government data. I think the private data is showing a mixed bag. For example, you saw ADP, the jobs numbers come out that were reasonably healthy in terms of job creation, but then just yesterday, you saw the Challenger Grain Christmas layoff report actually spike quite considerably. So I think we're getting this mixed picture here in the labor market. And if you were to think about the data trajectory, high layoffs, I do believe the sentiment out there feels that there is some softness in the labor market, and that is continuing. So the Fed doesn't have great data, but I believe that the direction that it's feeling is softening labor market.
So you just said the Fed doesn't have great data. How much faith should investors be putting in this data in the absence of that official government reporting that we're used to?
Well, I do think some of the private sector data can be quite useful and quite valuable. So I don't want to discount the private sector data. And in fact, I think it's probably more important than people give credit to in typical times, and maybe even over-rely on the government data and underappreciate or under-index on the private sector data. But only having the private sector data is a different story here. So I do think it's a challenging environment to not have the best data that you could have to go on, but the reality is that data isn't perfect. You do get revisions to data. There are models that are built into creating the data, adjustments, both for seasonal factors and the growth of companies or the growth of the economy. So it's a mixed picture here, but I think if you look at what's happening at the consumer level, at the corporate level, in terms of job openings and what you hear from survey measures, it speaks to a labor market environment that is weakening, and I think that the Fed probably has that same sense.
And it's interesting because companies are investing heavily in AI, but Fundstrat out with a note as saying that job losses in information and financial services ticked up. So what does that say about how AI is restructuring or maybe not restructuring the current labor market right now?
Right, and there's some in the market that are saying that AI is going to create more jobs in the long run, but so far from the labor jobs data that has been received so far from these private companies, you are seeing that it is actually the opposite, that despite what Fundstrat's saying is despite the billions of dollars that are being thrown into AI, you are seeing information services, business services, those jobs that are being cut. And instead, in the ADP report that was just mentioned, you saw an uptick in more old school jobs like in trade, in transportation, education, healthcare services. So you're throwing a lot of money at AI, but you're not seeing necessarily the job creation within AI. And in fact, in the Challenger report that was out this week, the second most cited reason why companies are cutting is because of AI and automation. The first reason being cost cutting.
And Brooke, holiday hiring is coming in much later this year as well. So what does that suggest about the state of the consumer heading into the holiday season?
Allie, retailers are trying to understand exactly what consumer demand would be and hiring accordingly to that. And so NRF put out a report yesterday on Thursday, and they said that they expect retailers to hire between 265,000 to 365,000. And that's far less than how much companies hired for the holiday last year, with a whopping number of 442,000 seasonal hires in 2024. And this really is sort of a put and a take. Normally, we're hearing about all these different companies announcing their big plan to really invest in seasonal hires for the time being leading up to the holidays. But playing into this, think about it. We had those Prime Day deals in October. We had those Prime Day deals in July. We know that consumers really went out to do some of their holiday shopping even prior to when we get to Black Friday. And so retailers are really thinking again about how exactly they're approaching the holiday season, especially in this environment where consumer demand isn't exactly what it used to be, and consumers are putting and choosing where exactly they're putting their dollars.
Yeah, we have been hearing anecdotally that holiday shopping is a lot earlier in the season than usual. But Brooke DePalma, Nesfre, Young Yu Ma, thank you all for joining the panel this morning. Coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves for the trading day. You won't want to miss it.